Welcome to Money Secrets with Bill and Mike.
I'm Bill Alexander.
And I'm Mike Tove. Bill, I think it's time for us to crack the egg and talk about the stock market.
Well, I think we should talk about investments in general because it's really a complicated world.
Yes, it is.
There are very few folks that truly understand it, but oftentimes it makes no sense at all to folks who are pretty smart, actually.
Yeah.
So I think it really is important that we discuss how investments are made, some of the pros and cons. What are they? What are you buying?
Yeah.
Those
So
kind of things.
we're going to come back in just a few minutes and we're going to get into this, and stay tuned, okay? Hey, welcome back. Oh my goodness, Bill, the markets. So many people, pretty much everybody's invested one way or the other, but the question is are they really aware of what it is they're doing and what the implications are and whether it's really good or...
Well, I know we have some stories we can share with folks.
Well, I want to start off with, I guess it's a case of just how, somebody once said you always start off with the bad, then you get to the good, and you're improving. But this one just sticks in my mind that some years ago I had a client show up in my office and wanted to create a retirement account, and had a very large portfolio of one stock, high tech.
I've seen that often.
And he wanted to do something with it that was going to be long-term retirement, and I tried to suggest that having one position was very, very risky.
No question about it.
Well, he didn't want to hear it. So what he said was, I can't do anything with it until it goes back to where it was, and it was down, okay? I said, that's dangerous, and he didn't want to hear me. So 4 months later, I ran into him, and I said, whatever happened to your stock? And he goes, he says it's bad. And I said, what happened? He says, I don't have it anymore. And I go, why not? And he said, well, I was margined. In other words, he was buying 50% with loaned money. Okay?
In other words, he borrowed money to buy the stock.
He borrowed money to buy stock. Thing lost 50% of its value. The margin call came in, and here's the real bad part. He still had to pay a very large capital gain on the day trading that he had done in the first half of the year.
Well, that happens to an awful lot of folks, and I've had lots of clients in the past like him who have worked for a company and purchased stock over many, many years, and at the end of the day, 90% of their investments are in that one stock, and they don't want to sell it because of the capital gains implication. Very, very risky. And I had a number of clients who were top management at Wachovia Bank. Well, we know what happened there, and I know I shouldn't use specific examples, but the bottom line is that the stock went from 100 plus down to about 5 or 6. I think when Wells Fargo actually purchased it, it was right around $6 a share. So folks who had $1 million plus portfolios basically lost almost all of their money because they didn't diversify.
Well, you look at Enron as an example.
Another example
is that the Enron employees had everything in corporate stock, and then when the company got into extremely hot water, they lost their entire life savings.
Well, and you know, if I go back to Wachovia had been extremely strong stock for 30, 40, 50 years, and but was it predictable that things might change when Wachovia actually was purchased by another bank?
Well, one of the things that I see a lot is a misunderstanding of what stocks and mutual funds and bonds are. People have a vague idea about these, but they're really, it's fairly simple. A stock is when you have a fractional ownership of a corporation. That's why there's voting rights. Now there's some kinds where you don't get voting rights, but
the bottom line is you're buying into the ownership of the company.
You're investing in the company directly. And when the company makes a profit, so do you. A bond is where you are basically making a loan to the issuer.
Well, let's go back. Because stocks and bonds are the key part of financial portfolios for the most part. Now, of course, people know about mutual funds because that's the way most people actually
Right.
get into the markets. But a stock, certainly you have risk of how good that company will perform, because you have dividends and you have growth, but you can also have where a stock doesn't do well at all.
Well, first of all, neither dividends nor growth are guaranteed.
Of course.
They are declared, the dividends are declared on an annual basis. It's a profit sharing.
Well, of course, there is one advantage, and a lot of advisors say buy and hold. And a part of that is most of those companies do pay a dividend that's regular, and there typically allows the investor to control when they have to pay capital gains tax. In other words, when they sell the stock and it has grown, then there's a capital gains tax that's paid, and being able to control.
Not with a dividend. Now remember,
Now,
the
understand,
dividend is a
dividends-
taxable event in the year, whether you touch it or not.
Oh, no question about it. And a lot of folks will take their dividends and reinvest it in the stock. And of course, that's going to be taxable whether you take it as a dividend or whether you reinvest it. But also, a lot of companies you're looking at growth, and that's a capital gain if the company grows, and the investor does control when the investment is sold and the capital gains tax is paid.
One of the things that's surprising to a lot of folks is there's been a lot of research on this. Two specific studies, one by Morningstar and one by a financial research group out of Boston known as the Dalbar Group. And in both cases, what the research has shown is that people that are constantly trading to try to beat the market actually underperform the market, and staggeringly so. The Morningstar report by 1/3, the Dalbar almost by 2/3 underperformance.
Right.
So the buy and hold strategy, which is old school,
All right.
once again is
Sometimes it's the best method.
sometimes it's got wisdom. But let's
Well,
go
first of
into
all, when we
this,
talk
yeah.
about stocks, tell folks what a bond is.
Okay, well, a bond is where you basically are lending money to a company in exchange for an interest payment. So it's called a coupon. Typically, it pays out every 6 months. So one is that you're not investing in a bond. You're basically a lender,
Right.
and you have a guarantee of return of principal, plus you have a guarantee of a fixed amount of money as an interest payment, as a dollar coupon. The problem is that payment is based on it's calculated as a percentage, so that when the interest rates in the future go up, the resale value of the bond goes down.
So it's very interest rate sensitive.
It's very interest rate sensitive.
And of course, most people are familiar with government bonds, U.S. government bonds particularly. Those are fairly low risk, obviously, because it's full faith and credit of
Right.
the United States government. But you have corporate bonds, and
Right.
some of those are relatively low risk, but others can be very high risk, or what's called junk bonds.
So let's take a short break, and then we're going to come back and we're going to talk about a little bit more about the differences of these. Stay tuned. Welcome back. So we were talking stocks and bonds, but really what most people know are mutual funds.
Absolutely, and that's what most investors use. Clearly, whether they're the best investment option for folks, that's a different matter. But it is what most investment advisors use, and what most people use when they're actually making investments into the markets. The best story I have is really with my mother. She went to the bank, and the bank pushed her into purchasing a mutual fund that they were pushing, which is not an unusual scenario, unfortunately, because at that point she really didn't understand. My father had died, and she had to take over all the money management. And she's a very shrewd woman. I mean, very smart, lucid, very good understanding. And over a period of time, she actually did quite well, but the thing that really got her with what she got into was the mutual fund did not perform very well. There were high fees to it that she didn't really know about when she got into it. And then she ended up, because of the way mutual funds actually report and pay income, that she lost money in the mutual fund. In other words, it went down in value rather than up, and she still had capital gains tax to pay, which, and that is so frustrating. I hadn't seen my mother that mad in many, many years when that particularly happened. But that happens with mutual funds.
Not an uncommon story, and that's not to say that mutual funds are all bad or all good. It's all, but they're more complicated. And the thing of it is that people go, oh no, they're easy, and it's like, yeah, it's like getting into your car and saying, hey, a car is easy. It has a gas pedal, it has a brake pedal, it has a gear lever, and it has an ignition switch, and that's all there is. And if I really want to get complicated, there's a radio.
Right.
Open the hood.
Right.
And see what's underneath.
Well, folks need to understand that there are more mutual funds than there are actually stock companies in the world.
Right.
And and they're different because they have different objectives. And so you have to find a fund that is consistent with your own objective.
Except here is the funny part, is that if you look at these actual different funds of different objectives, and you actually start superimposing one on the other, what you find is that two funds with very different stated objectives in terms of total performance are virtually identical.
They can be.
And so one has to be a little bit careful, and how do you know it?
Or skeptical.
So you go to that document that they give you, about yay thick, called a prospectus.
Right.
And in that, now what do people say? Oh, I don't want to read those things, right? They're complicated. Well, yes, that's kind of the point.
Well, actually, one of the things that I have always been very skeptical about mutual funds, even though they do offer diversification within the objective normally. But the thing about it is, with a mutual fund, when you buy it, you don't buy it at the moment that you tell someone to buy it for you.
Right.
You buy it at the end of the day based on whatever the price is. So you don't know what the price is going to be. And the same thing happens if and when you want to sell. And if and when you want to sell, one of the most unfortunate circumstances for many investors is, even if they're shrewd enough to call their advisor or go online and do it themselves to sell their mutual fund, when the market is dropping, oftentimes they take the full lump of the market drop because the mutual fund is not sold until that night.
And
so unfair.
Well, it is. Now there is a new approach to this, and it's called an exchange traded fund. And I don't want to try to get into the nuances of the differences between ETFs and mutual funds, but the one advantage of an exchange traded fund is that they do execute in real time rather than at the end of the day.
Oh, I agree. In fact, there are a lot of similarities between ETFs and mutual funds, and I like ETFs a whole lot better in terms of, I think it's as it relates to those investments. And of course, as you know, that's just another investment opportunity for folks.
And to be fair, in my practice, when I do investment recommendation, I actually end up recommending both. There are times when mutual funds are appropriate, and there are times when ETFs are appropriate, and it really depends on the client's individuality. Well, there we go again.
Well, it all comes back to the individual investor. You know, how much do they have that they can actually invest appropriately, because that varies with everybody. Objectives make a whole lot of difference. The age of the investor makes a big difference.
Oh my God, that is probably age and risk, and those two things relate to each other. But more than anything else, people love to chase returns, and they ignore the other side of the equation, which is risk. And a proper assessment of any investment, whether it's a stock, a bond, a mutual fund, an ETF, has to do with risk and return in conjunction.
Right.
Risk-adjusted return.
Well, and even a bond has a good bit of risk to it.
Bonds have risk. It's just different.
Right. Different kind of risk.
Different kinds of risk, but yes, bonds do. So we're going to take a short break, and we're going to be back and start to wrap this up and look at what our money secret for the day is. Stay tuned. Welcome back.
Well, Mike, even folks that don't think they are investors actually are investors, because most people actually have a 401k plan at work. And a 401k plan is an investment plan that's selected by the employer.
Correct.
And so I think it's important we talk about 401ks.
Yeah. Well, first off, most people, that's the majority of what most people are invested in. And because it's sort of done for them.
Well, years ago, your home was almost always your most valuable asset. And now, today, oftentimes, for folks who've worked for 20 years or more, actually their 401k is their biggest asset. And
there's a number of challenges with that, not the least of which is that you have limits on your ability to get at it. You can't just get out from under the investments if suddenly you say this is a completely bad set of choices. You have to stay within the menu.
You're stuck with what your employer has chosen for you in terms of the investments that you can select from. That's been a frustration.
And the other thing is that people looking to get away from risk, they're going, I think there's going to be a stock market correction. So they say, I want to get away from risk. Well, all they're going to end up doing is they're going to move, they're predominantly 401ks or mutual funds, so they're going to move from a stock market or it's called equity group of funds, which is predominantly stock-based, to bond-based. And that's fine. You reduce your exposure to stock market risk by being in bonds, but your returns go down. And so
in other words, bonds generally make less money than
and especially
equities.
These days, bonds make a tremendously small amount of money, if that's an oxymoron. But here is where it gets worse. And that is that interest rates are going up.
Right, no question about it.
And as interest rates go up, the resale value of bonds goes down.
Right.
It's just
so any bond that's already been issued, in other words, if you've bought a bond, then if interest rates go up, then the underlying value of that bond will go down.
Now, the good news is that that's not 100% correct with mutual funds that are based on bonds, because there's many different bonds in there, and some of them are shorter term, and so the managers get to buy and sell and trade.
Right.
But we do not see bond funds do well. And we have not seen bond funds do well over these last many years with interest rates very low.
Correct, no question about it. Now, I mean, most people have fled to equities because they can't make any money in bonds.
That's correct. And so it becomes a bit of a darned if you do and darned if you don't type of a thing.
Now, for folks who don't know, equities means stock.
Equity means stock, yes. Right. And to be complete, and the term debt actually means bonds. So when people talk about debt instruments, they're not talking about your credit card.
Right.
They're talking about bonds.
For most of us.
For most of us. But the challenge is that, and plus when you're really captive to what your employer wants you to have.
Well, the biggest mistake I see folks make is they make their selection of what funds they want in their 401k portfolio when they initially get their 401k, and then they never look back and modify their investments.
Right.
Well, that's absolutely crazy.
It is, except the reason is because who's there to advise them?
Correct.
The best they can do is they can call up their human resource department and they can go to their HR person. But the problem with that is that
well, the employer can't tell you how to invest it. All they can say is, here are our investments.
They cannot tell you how to invest, but more to the point, the HR person may not have any more information about what really is going on than you do.
Well, and truthfully, just because they're in HR doesn't mean they understand investments either.
That's correct. Welcome back.
Well, Mike, with our money secret, where clearly advice means an awful lot, it also is important for folks to get as much learning and education as they can on these things, because the more you know, the more an advisor can help you.
That is right.
And of course, we hope this show makes a difference to folks, but tell folks
that's why
about
we
our
have
book.
Our book. Yes, we have a book that's going to be coming out, and the book is called Money Secrets with Bill and Mike. What a
great
surprise.
name.
Yeah. And so the quickest and the easiest way to get it, it's not quite out yet, but But when it does, give us a call and schedule a time to come in and visit, and we'll be glad to get you a copy. So I'm Mike Tove. I'm a financial advisor. I have an independent agency called AIN Services. We can be reached at 800-363-2296, or check us out on our website at www.ain-services.com.
And I'm Bill Alexander. I'm an attorney with W.G. Alexander and Associates in Raleigh, and we focus on estate planning, elder law, and asset protection. And I also do financial reviews for my clients. Please chime in and help us. Also, listen on Saturday mornings. I have a radio show called Asset Protection Today at 11 a.m. on WPTF 680 a.m.
And stay tuned, and next week we're going to pick up a second part of this, and we're going to talk about, are the markets about to crash? So tune in next week, and we'll see you then.
See you then.
Care.